If you're part of an ongoing recession and want to make something of yourself out of it, you've come to the right place. A recession begins when the economy reaches a peak of activity and ends when the economy reaches its trough. Today, we're going to talk about how you can stay on track and be financially secure during a recession. Stick around because some of these tips might end up turning your life around. Let's start. Number 1. Stock up when they're cheap. Buy low, sell high is a strategy when you buy stocks or securities at a low price and sell them at a higher price. This strategy can be difficult as prices reflect emotions and psychology and are difficult to predict, but it's obviously the smart thing to do. Buying low and selling high is generally a good strategy as it allows you to take advantage of price movements in the market. However, there is no guarantee that this strategy will always be successful, and you may end up losing money if the market conditions are not favorable. Over the long term, the drivers of the market as a whole follow a consistent pattern, moving from fear to greed and back to fear. Times of maximum fear is the best time to buy stocks, while times of maximum greed are the best time to sell. Number 2. Multiple income streams. It's never been more important to have multiple income streams. The current climate has shown us that no job is safe, so having more than one stream of income can help us spread out our bets and ensure that we're always covered financially. An increasing number of individuals are creating multiple streams of income for themselves through side hustles or passive income sources. Having various sources of cash flow has become well favored for good reason. There are a plethora of benefits including additional financial security, paying down debts, and more. Adding an extra income source can go a long way in paying for higher everyday costs. You'll have extra money to spend on essentials, to put towards your savings and investments. Having more income streams might mean you can actually work less. Passive incomes such as investments, digital products, and online courses can give you increased flexibility in the amount of hours you need to work. By building and nurturing multiple streams of revenue, you can create for yourself and your career that you probably wouldn't have otherwise. Maybe you can take a job with more flexible hours, even if it means sacrificing a portion of your salary. Number 3. Invest in real estate. Being sturdy and reliable, people have always considered properties, residential as well as commercial, to be the most viable investment option. However, during unprecedented events such as a recession, many often wonder whether a real estate investment can weather the storm. Over the last 70 years, despite several recessions, real estate values have continued to go up. In fact, there have been instances where the values have increased even during the recession itself. But even if an economic turmoil causes a hot housing market to cool down, that's still great news for investors since this could potentially open up opportunities to purchase properties at discounted rates. The best investments during a recession is residential properties. There's surely someone or another on the lookout for a home. Since it's a basic need, housing always has a demand no matter what happens. You might be under the impression that commercial real estate is more dependable and profitable. But since people need a shelter over their heads, people aren't subject to global economic conditions and thus making for good investments. Number 4. Precious metals. Precious metals are rare metals that have high economic value. They're valuable because they're scarce, useful for industrial processes, or have investment properties that make them a good store of value. Notable precious metals include gold, silver, platinum, and palladium. Gold is the most well-known and investable precious metal. It's unique for its durability, it doesn't corrode, shaping capabilities, and ability to conduct heat and electricity. While it has some industrial uses in dentistry and electronics, it's primarily used to make jewelry or as a form of currency. It has long been a store of value. Because of that, investors seek it out during times of economic or political turbulence and as a hedge against rising inflation. Silver's dual role as an industrial metal and store of value tend to make it more volatile than the price of gold. The volatility can have a big impact on silver stock prices. In some cases, silver prices can outperform gold during periods of high industrial and investor demand. Palladium is used in electronics and industrial products, dentistry, medicine, chemical applications, jewelry, and groundwater treatment. While rare and highly valuable for those purposes, investors don't put as much emphasis on palladium as they do on other precious metals. Number 5. Never time the market. The biggest risk of market timing is usually considered not being in the market at critical times. Investors who try to time the market run the risk of missing periods of exceptional returns. It's very hard for investors to accurately pinpoint a market high or low point until after it has already occurred. Imagine for a moment that you've just received a year-end bonus or income tax refund. You're not sure whether to invest now or wait. After all, the market recently hit an all-time high. Now imagine that you face this kind of decision every year, sometimes in up markets, oftentimes in downturns. Is there a good rule of thumb to follow? Research shows that the cost of waiting for the perfect moment to invest typically exceeds the benefit of even perfect timing. And because timing the market perfectly is nearly impossible, the best strategy for most of us is not to try to market time at all. Instead, make a plan and invest as soon as possible. If you can make an annual investment and you're not sure whether to invest in January of each year, wait for a better time, or dribble your investments out evenly over the year, be decisive. The best course of action for most of us is to create an appropriate plan and take action on that plan as soon as possible. Number 6. Core sector stocks. Core holdings are the central investment of a long-term portfolio. When building your portfolio, it's essential that the core holdings have a history of reliable service and consistent returns. Core holdings in a well-diversified portfolio tend to outperform a portfolio consisting entirely of growth stocks. A portfolio with core holdings that are consistent and reliable will benefit from stable growth in safer sectors of the economy, while also taking advantage of growth opportunities in its non-core investments. When you build a long-term portfolio with core holdings, it's also easier to monitor and rebalance because it only contains a few investments. Furthermore, with this type of strategy, investors can expect less volatility and drawdowns than in an active managed portfolio. This can help limit any negative effects of taxes and trading commissions on returns. Number 7. Reliable dividends are the best. The beauty of stocks that pay dividends is that part of your return includes predictable quarterly payments. Not every company offering dividend stocks can maintain a dividend payout in every economic environment, as the COVID-19 pandemic has demonstrated. But a diversified portfolio of dividend stocks can produce reliable income, rain or shine. Dividend investments can be a great investment strategy. Dividend stocks have historically outperformed the S&P 500 with less volatility. That's because dividend stocks provide two sources of return: regular income from dividend payments and capital appreciation of the stock price. The total returns can add up over time. Because of their lower volatility, dividend stocks often appeal to investors looking for low-risk investments, especially those in or nearing retirement. But dividend stocks can still be risky if you don't know what to avoid. Here's a closer look of how to. Number 8. Jump career smartly. For an experienced professional, contemplating a career change can be just as challenging as actually going through with it. The fear of failure, the uncertainty, or the risk of these changes being irreversible can lead talented people with transferable skills to stay comfortably where they are. However, there are many advantages to a career change. If you stay in one company, your basic salary will probably increase by an average of 3 to 5% each year. If you move companies or change careers, you may be in a much stronger position to command a larger increase that would either be in line with the industry you're moving into, or you may receive a higher percentage increase on top of what you're currently earning. Of course, it's not all about money. Changing your career can mean that you will have the opportunity to take on more skills or expand the ones you already have. Simply working with a new team or manager will also help you learn valuable new skills. A change in career also enables you to move up in your career, especially if your current one is stagnating, which often happens. With a new or higher advancement comes increased responsibility, which is favorable for your CV and professional well-being. Number 9. Build new skills. Learning a new skill is an excellent way to break into an industry, make yourself more attractive to employers, or earn more money and responsibly in your current career. But between work, family life, and the thought of spending years in a classroom can be overwhelming. Fortunately, you don't have to. It's possible to earn many in-demand skills in less than a year, some in just a few weeks or months. Potential earnings increase for adding new skills to your resume are wide-ranging. But the more skill you can bring to the table for an employer, the better your advantage over the other candidates. The higher your value in your industry and the more negotiating power you'll have when discussing your wage or salary. Global megatrends such as the rising role of technology, climate change, demographic shifts, urbanization, and the globalization of value chains are changing the nature of work and skills demand. To succeed in the 21st century labor market, one needs a comprehensive skill set. Number 10. Invest in your retirement. Someone turning 65 this year has a 70% chance of needing long-term nursing care. Women, on average, tend to need 3 years of supportive care as they approach the end of their life. Only 20% of today's 65-year-olds won't need long-term supportive care. It's more important than ever to have a realistic retirement savings goal and a solid plan for achieving it. With the help of a free retirement checklist and a fiduciary financial advisor to help guide your decisions, you stand a much better chance of retiring comfortably and maximizing your sources of income so you can live the life you want. So, why is retirement planning important? You probably know a lot about many things in life. But when it comes to retirement planning, there are literally thousands of factors that can impact your ability to maintain financial security. Hopefully, you'll only retire once, but this also means you lack the experience necessary to identify critical questions and answers that can contribute to a successful retirement. Financial stress is linked to physical conditions such as diabetes, heart disease, migraine headaches, and poor sleep. Not only that, money worries can cause anxiety and depression, robbing you of peace of mind to enjoy your life today. Taking steps today to get your retirement planning on track is an important step in your overall financial wellness, which can only be good for your physical and emotional health. So, when are you going to stop sitting around and start working on getting above everyone else, making use of a recession and building your wealth? Soon, hopefully. If you liked the video, you know what to do. We'll see you in the next one.